Hello everyone, my name is Jacob Michaelsen. I am Head of Sustainable Finance Advisory at Nordea, and I'm very excited to welcome you all to this event, the 2020 Nordic TCFD Reporting Summit that we are co-hosting together with the Climate Disclosure Standards Board. This is, I think, quite an exciting development that we're seeing in the market currently, and we're very happy to be able to bring you some very hopefully relevant insights, and I believe we have quite an interesting agenda set up for you. Before going into that and then officially kicking off, I'll hand over the word to Michael to share some of his reflections as well.
Thank you very much, Jacob, and thank you very much also to you and your colleagues at Nordea for working with us to make this summit happen. I think we have a few years of collaboration now, and it's always a very pleasant one. So I'm very excited to have this opportunity to be working with you again. So before we kick off, I just wanted to offer a few thoughts on the state of play, and also to give a few hints about the future direction of travel in terms of TCFD implementation. We have this summit, so to speak, as the TCFD has just launched its most recent status report, and also as we hear news about many of the ESG standard setters, including ourselves at CDSB, working together to push this agenda forward. And at the same time, on the European level, we see the Non-Financial Reporting Directive being revised, with the TCFD being a key element of the discussions. So it's a very good time to take a second, even though we can't have you can't be with you in person, to look at what's happening and think about the future direction of travel. So I think it's fair to say that momentum continues to grow and to build around the TCFD, both on the voluntary and the mandatory level. We've seen the largest increase ever in the short history of the TCFD of the supporters of the task force, be that through companies, but also through governments. So now we have over 1,500 supporters of the TCFD from the private sector, and over 110 sort of government supporters or various institutions, with 85% of these supporters coming in just in the last year. On the mandatory side, we see the EU, as I mentioned, very much putting the TCFD in its non-binding guidelines, but also at the heart of its sustainable finance agenda and revisions. New Zealand was the first country to announce the implementation of the TCFD recommendations on a mandatory level or on a comply or explain level, and they're working hard to make this happen. Just the other week, the UK has set out an ambitious 5-year plan to implement the TCFD recommendations across its market, both on the company side, but also on the investor and financial sector side, in the next 5 years. And that will of course mark an impressive increase in the implementation, but also countries like Canada working hard, and Australia and others. So there is clearly momentum happening, and we as ESG standard setters and frameworks take this support very seriously and listen to the market's practices and interests acutely. So we, the 5 major standard setters, CDSB, CDP, SASB, GRI, and the IOSCO, have been working hard to further align and have published an intent to work together towards a more comprehensive reporting landscape in this space, and we take this very seriously. While this area focuses well beyond climate change, the TCFD and climate change and climate risk is at the heart of this process, and it will also carry alongside this process. As part of this work, we're looking at the ever-evolving concept of materiality. I think we could probably have a full day session just around materiality, but just to say that we are looking at how to look at both sides of double materiality, both the impact of the environment and the business, and thinking about how to look at financial materiality to better encompass all those variables that influence the enterprise's future ability to create value. We call it enterprise value creation mentality, but also sort of the impact side of things as well. We have published our intent to work together, and we hope to publish the next step of our work in the coming weeks or months in terms of how this might look like in practice. This is a significant shift in making sure that the landscape is harmonizing, it's simplifying, and strengthening to make sure that we give the market the information it needs to make the best decision possible for people, planet, and the economy as well. So as this has been developing, we have also seen not just the ESG and sustainability space moving forward, but the real financial sort of heavy hitters as well in terms of reporting, with the International Financial Reporting Standards Foundation, the IFRS Foundation, stepping in and putting out a consultation on their role of sustainability reporting, proposing to set up a sustainability standards board alongside its International Accounting Standards Board to further harmonize this space. And this is a very welcome step in the right direction, and we hope to be very much working together and perhaps even coming together in that process to make sure that we use and leverage the work that the financial system, that the financial reporting world has already achieved to harmonize and align internationally. And so please watch this space. There was a lot more coming out, especially now that IOSCO, again, a very important player in the landscape internationally, has stepped in and expressed its support of these initiatives. I think the next few months or next year or so, we'll see a lot of changes, and changes for the better. We don't have time to spend too much time working our issues out. We have to make sure that we are ready to address the very short time frame of climate risk. So what is the market doing? And we'll talk a little bit about this, and we have some excellent speakers, and we have at CDSB also produced some research on how European companies are doing, and we'll even give you a bit of a sneak preview on our most recent research. The TCFD, and we have Martin from the task force here as well, so I'm sure he will cover this as well to a certain extent. But the recent TCFD sales report has showed some promising signs, but it's also been quite realistic about the progress made. There is an evolving and increasing a number of companies working to implement the recommendations, but we need to move faster. That's very absolutely clear from the findings, and that's very much supported by what we see in Europe, but also elsewhere in the world. Particularly TCFD, the F of the TCFD, is an important element. Financial impacts are key reason and driver and sort of part of the theory of change of the TCFD, and there we need to see a lot more happening. It's a difficult area, but we see some examples of good evolving practice, and we hope that we move faster there. We also saw that only 1 in 15 companies are disclosing the resilience of their strategies. This is a key element of the Tcsd recommendations, to communicate to the market, to your current and potential investors, how you are prepared for the future and what you are doing to make sure that you are ready for whatever the future brings. We need to do more here. We see from our research that Europe is certainly towards the towards the front of the pack, and we see great progress happening with Nordic companies, especially closer towards the front. But that doesn't mean that we are done yet. We are not there yet, and we still have a ways to go, and we need to do this quickly. So I hope that today we can spend a little bit of time thinking about where we have to celebrate the success, because we should celebrate progress. It's not an easy process, but that we also take a moment to just take stock and see where we need to go and how fast we need to go. So hopefully today will also give you a bit of a time to think about what you can do in your role to be part of the solution and to be part of making the TCFD recommendation as a success, and therefore making this task force's contribution to the future stability of the economy, but also the planet a success. So I very much look forward to the conversation today, and once again thank you to Nordea for partnering with us for this event, and I'll hand back to Jacob. Thank you.
Thank you so much, Michael. And I think, as you can all hear from Michael's both passion and excitement about this, but also his broad coverage of setting the scene, we can obviously in no way cover all of that in detail in just 2 hours. So we've tried to really give you the essence of this, and obviously always happy to follow up and discuss with you more after this. And again, just to remind everyone, this is actually being recorded, so you can also come back and listen to many of the hopefully relevant points mentioned. Very quickly, a few practical notes. There's a chat function, as I can see one of you have discovered already. Please all just use that chat function, write any questions you might have. We probably won't be able to get to them all, but we'll try to then look at them and see if we can get back to some of you afterwards as well. Otherwise, I should mention that we have really set up the day in two parts, or the webinar in 2 parts. The first one will go a bit more into sort of a conversation with Martin Skanke and Hilde Rød from Equinor, sharing their insights on the developments. And then we are afterwards going into more sort of practical aspects. Again, we'll hear a presentation from Michael and his colleague Nonto, and also then going into actual case studies facilitated by Luke. So plenty of interesting insights. Company like Stora Enso, Equinor, Skanska, and IOSCO all sharing their insights. So I think we have quite an interesting an hour and 45 minutes ahead of us. So with that said, and no further ado, I'll hand over the word to my colleague Alexander Berg, who will take us through the first part of the day. Alexander, are you with us?
I am.
Wonderful. And Hilde and Martin as well. So Alexander, the floor is yours.
Thank you. Good morning, everybody. My name is Alexander Berg. I'm part of Nordea's Sustainable Finance team. And I have the pleasure this morning to guide you through the first part of the program. We will soon hear from our keynote speaker, Martin Skanke, followed by remarks by Hilde Rød, as Jakob said, from Equinor. Then, after these 2 short presentations, we will invite Martin and Hilde to a conversation about sustainability reporting from the perspective of the TCFD, the world of investors and companies. And this will take up the first part of the program until roughly 11 o'clock. Let's start by introducing our keynote speaker, Martin Skanke. Martin started his career at the Norwegian Ministry of Finance, and he has also been the Director General at the Office of the Norwegian Prime Minister. He chairs the PRI, the Principles for Responsible Investment, and is a board member of several Norwegian financial institutions, such as banks and insurance companies. He also chaired the Norwegian Climate Risk Commission, which presented its report on Norway's exposure to climate risk in 2018. And important for this context, he is a member of the TCFD. Much looking forward to Martin's input. Martin, the floor is yours.
Thank you so much for that very kind introduction, and thank you for inviting me to this event. It's always a pleasure to be able to talk about the TCFD. I thought it would be useful maybe to just take a step back and think about, or give a little background on how we thought when we set out the reporting framework of the TCFD back in 2016 and 2017 when we were working on the first draft of this reporting framework. There were very many other climate-related reporting frameworks around at that time, and obviously we needed to think carefully about how we can add value, what was missing. And I think and I'm oversimplifying a lot here, but if you look at the climate-related disclosure frameworks that were around at that time, they were primarily about how companies affect the climate through their emissions. So they were related to emissions reporting and carbon footprinting. We thought that if we wanted to make a reporting framework that could give some guidance on capital allocation and other decisions that are important for investors, it was not really so much about how companies affect the climate, but about how climate change and climate policies could affect companies financially. So there was always a very strong sort of financial materiality lens on the reporting framework. And this reflects the important role of investors in a market economy, because in a market economy, it's really investors that are responsible for capital allocation and for making sure that capital flows to the most productive uses. And in the climate context, we know that we need to make a transition to a low carbon economy. What we don't know is the extent to which that transition will happen through a transformation of existing companies or by existing companies being built down and new companies being built up. So will the car producers of the future be today's car producers who have become leaders in electric vehicles, or will newcomers like Tesla and others take their place? Will the energy companies of the future be today's fossil fuel companies who have transformed themselves into leaders in renewable energy, or will new players come and take their place? So in order to answer those questions, we need more information about corporate strategies. And so really reporting on stress testing of business models is at the core of the TCFD. So we ask these questions around governance, how companies manage climate risk and the climate transition, about strategy, about risk management, and metrics and targets. I think it's fair to say that by far the most challenging question and the thing that people have struggled most with is the question around stress testing of business models, or the resilience of business models. And the wording of this is significant. It says, describe the resilience of your organization's strategy, taking into account different climate-related scenarios, including a 2-degree or lower scenario. So the focus is on the organization, on the entity. And I think it's maybe useful to think of a company, an organization, as being two things. It's a portfolio of underlying projects. So an oil company will have an oil project and gas projects, et cetera, et cetera. But it's also the platform that you use as an investor to access the value creation from those underlying projects. So really we ask two questions of companies. One is, what does an optimal portfolio of projects look like? But the other is the company really the best platform for accessing the value creation of those underlying projects? So maybe you want to invest in renewable energy, in wind power, for instance, but do you want to do that through a fossil fuel company platform or a dedicated renewable energy investment platform? And so the focus is very much on the organization and how it sees its strategy developing over time. And I should also add that the focus is very much on the process of strategy and the process of capital allocation. So it's partly about an internal corporate process. How does stress testing scenarios feed into a strategy process internally? And it's about an external process, how you can use this to have a meaningful dialogue discussion with stakeholders, your owners, obviously, but also other stakeholders. So it's a mistake to think that TCFD reporting is about producing a glossy report and that is sort of the end product. This is intended to be an iterative process, a process of discovery, a process of learning, a process of stress testing, where you make an assessment, a stress test, and you have a dialogue with your stakeholders, and then you improve as you get new information. So the focus is very much from our side on this process and not so much on the report as an end product. It's not about compiling a report, but it's about reflecting on how this type of information can help both companies and investors to make better decisions so that we have a smoother and faster, less costly transition to a low carbon economy with less risk of assets being stranded in non-productive use. So I think that's an important starting point for just a discussion around what good reporting is. Good reporting has to be seen in the context of the objectives of reporting, and those objectives are related to capital allocation. As Michael said, we just released a status report, and I think you summed up very nicely the findings, which is, yes, there is progress, but it's not happening fast enough, so there's still more to do. Through that process of working on the status report and all the data that goes into that work, we very quickly saw that there were some areas that people struggled with more than others. And it's not surprising that this whole issue of stress testing and scenarios was one of the most challenging areas. So in addition to the status report, we published also a guidance document on scenarios and how you can use scenarios. So hopefully that's helpful and can help get more reporting and better reporting over time. And we also published a guidance document on risk management. So how can you integrate climate risk management into risk management processes? And I think this is a crucial point because climate risk is not a separate risk factor that lives its own life sort of in parallel to other risks. It is a business risk that has to be integrated in a risk management framework. And we thought it would be useful to publish a document that gives a bit more detailed guidance on how that can be done. So hopefully these new documents will provide some help and guidance and improve the quality of reporting over time. So I think I'll end there for now, and then we can maybe come back to some of these issues in the discussion. Thank you.
Thank you very much, Martin. Very insightful, and it's always best to hear these things from the very people who are responsible for these documents and for the recommendations. I was wondering about if I can ask you one follow-up question about how the companies that are supposed to produce these TCFD reports perceive this new focus on transparency. So if the point of a TCFD report is to increase transparency on exposure to climate risk, how do companies that are to a large extent exposed to, for example, transition risk, how do they deal with this? So I'm thinking of the Climate Action 100 Plus initiative, among others. And I was wondering whether you could share some reflections on how the high emitters, how they perceive this new focus on transparency and risk exposure.
So the Climate Action 100 Plus is now the world's largest collaborative engagement effort. So we now have about 500 investors globally engaging with about 160 of the largest emitters in the world on emission strategies, on climate risk, on management, on trajectories, stress testing, etc. So this is not exactly the same issues for each of the 160 companies, but on the same themes. Overall, I think the experiences of this has been, they have been good, positive. I'm encouraged by the results. I feel that this has been constructive overall. I think that from a corporate perspective, I think these are issues that, the corporates would have to answer to anyway. But hopefully this collaborative engagement has actually made this easier in the sense that you now can engage with 2 or 3 investors on behalf of the larger group rather than dealing with hundreds of investors individually. And I also think that having the TCFD as a framework makes it a lot easier to calibrate sort of expectations on reporting instead of having again, many different investors coming with slightly different requests around what kind of reporting you want. So my overall impressions of this are fairly positive. I think it's been worthwhile, but Hilde Rød from Equinor has seen this from the other side as being, delivering reports to investors. So we'll see if they have seen it as, constructive. I think from the investor side, and looking at this, across the board, obviously the 161 companies in this effort are very different and are very different stages of transparency. Some companies like Equinor have always been very transparent and others are lagging significantly behind. So I think there's sort of a broad range of different companies.
Very good. Thank you. And that was a perfect segue to our next speaker, to Hilde Rød. Hilde is a vice president for sustainability at Equinor. Hilde has previous experience from the Norwegian bank, the largest Norwegian bank, DNB, and also from the UN Development Program. Equinor, as Martin also said, has for a long time been one of the leaders when it comes to transparency and sustainability reporting. This has been measured by a Norwegian NGO called the Governance Group, which has produced reports on ESG transparency by the biggest listed companies in Norway, and Equinor has, for the last couple of years, held one of the top ranks. And I would assume that a lot of that is the credit of Hilde's work and her team's work. So I'm very pleased to have Hilde with us today. And Hilde, the floor is yours.
Thank you, Alexander, and thanks to you and Martin for your kind words about our efforts to try to implement the TCFD. So I have a few slides, but I thought I'd just start reflecting a bit on our journey with the TCFD. Maybe if you can move to the next slide. We in Equinor, I would say we had a bit of an advantage when the TCFD came, because our journey on TCFD in a way started before the TCFD, because we were at one point, I think it was back in 2015, asked by an investor coalition called Aiming for A to stress test the portfolio against the range of IEA scenarios. So this was a bit of a forerunner to the TCFD, I think. And at that time, there weren't many companies doing that, and we were scratching our heads. How do we go along? And actually started looking for concrete examples. And we found some examples from BHP Billiton, but there was very little out there. So we had to test and try and find our way. And I think in many ways that's what we have continued to do. Reporting and assessing climate risk is not something you necessarily solve once and for all on your first attempt. It's more of a continuous journey, and you evolve as you go along. But I think we got a bit of a head start, and we're able to be a very early implementer and supporter of the TCFD, and we've benefited from that. But we're still on a journey, I would say. And for us, it's been particularly useful in this context to look outside and have dialogue. We have learned a lot from collaborating and learning from our peers. We inspire them, and they inspire us, so that we continuously try to enhance and improve our disclosures. And we were part of one of the first TCFD preparer forums. This was organized by the World Business Council for Sustainable Development, and that was immensely useful for us. And in parallel, we have also reached out and collaborated with financial institutions to better understand what are useful disclosures. And for example, we made a case study together with Storebrand a couple of years ago, and the PRI. That was very useful, I think, for both parties to better understand how we could disclose information that was actually useful and improve our disclosures. So for us, sort of, how did we get there? This first request We started in a way with the most difficult part, with the sensitivity analysis and stress test. I'm not sure I would recommend starting with that to others. Maybe it's better to start with the sort of risk and governance section, which are a bit easier to embark on. But what has been crucial is a very close collaboration between the CFO area and sustainability, and later on also strategy. And we've seen that what is special with the TCFD is what Martin mentioned, that it looks at business risk to business from climate change, which is different from more traditional sustainability reporting, looking at the impact. And this view on sort of what are the financial risks has triggered, more interest perhaps within the CFO area, for example. So I think that has been crucial, and we have built as far as possible on existing processes, trying to embed this into our enterprise risk process. But we had to adapt it. I think the time horizons of climate risk are very different from the time horizons you usually use in climate risk. Important for us was also to do some deep dives with the board and the top management, not only on climate risk, but the broader climate agenda, to really get on board with the terminology, the concepts, etc. So that was immensely useful and also paved the way for more strategic discussion. So in terms of what have we done in practice, on the next page I have a few examples. And for us, assessing climate risk is very much about transition risk. I think the concept and terminology in TCFD of the physical risk and the transition risk has been very useful for us, providing us with the vocabulary. But for oil and gas companies, it's really all about the markets and regulatory risk. So we have boiled this down to market risk. And for us internally, maybe it's what we see on the left-hand side, how we integrate this into decision-making. That is the most important part. It's how we look at robustness targets, break even when we sanction projects. It's integrating and using a carbon price of at least $55 per ton of CO2 everywhere in the world for all projects, for example. But we also conduct an annual stress test where we look at what would the impact be on the valuation or the net present value of our total portfolio if we changed our assumptions on future oil and gas prices with the assumptions in various scenarios, such as, for example, the sustainable development scenario. So, and that, of course, is perhaps what has been most useful for the outside world and where we've seen most interest. But I would like to stress that for us, it's not necessarily the result of this stress test, but rather the discussions leading up to it and how we can integrate the climate risk thinking into decision-making on a project basis that has been much more useful. And then finally, on the next page, try to sum up what we see as some of the key learnings and benefits from our journey with the TCFD. And as I said, I think this terminology and guidance is very useful, and I would encourage everyone to look at the TCFD pages, and maybe also if there are preparer forums for your industry, to just look for concrete examples and inspiration. I also think that having deep dives, concrete deep dives to really dig into this, set aside time, at least for us, that has been crucial. And one of the key benefits of this climate risk approach is that there is a totally new time horizon applied. At least for us, that was a bit of an eye-opener, and it has paved the way for very interesting strategic discussions, and also enabled us to, for example, now recently set a net zero ambition by 2050 across the value chain. I think finally also look at the process of assessing risk, not necessarily finding the answer, but the discussions with the board and with the corporate executive committee and across the company. Look at that as the key benefit rather than just making the report itself. And then, as has been said earlier today, I think there's still think there's a way to go in terms of harmonization and standardization, and at least for us, those are some of the most important improvement areas going forward. Thank you.
Thank you very much, Hilde, for your insight. I think it's quite interesting that both you and Martin mentioned that it's not necessarily only the end product, the report itself, that is the goal here, but it's that the process of getting there has a lot of learning for companies, and that it is not a one-off. That this is a process that has started and that continues and that is being improved continuously. I think that is a very relevant and an interesting point. I want to, if I may, flip the question that I asked Martin about the Climate Action 100+ around to you, since you're then on the other side of the table. So investors are very happy with this approach of asking the biggest emitters to be more transparent and to engage with these companies on transparency and climate risk disclosure. How was your experience of this process? Is this something, an opportunity that you embraced? How did you experience that?
Yes, thank you. And indeed, we have had a dialogue with Climate Action 100, I think, for 2 years now. We have a joint statement with investors representing that group from 2019. And we also received a letter from the Climate Action 100 group earlier this year with sort of renewed requests. I think we definitely tried to embrace those kind of initiatives, and it was also a follow-up of the examples I mentioned at the start, with investor dialogue being a bit important part of how we shaped our disclosures with the Aiming for A coalition and also the case study with Storebrand. And I think Climate Action 100 in many ways is a continuation of that approach. So I think it's very sound to be sort of challenged and also encouraged to continue what we're doing. We see that the TCFD thinking is at the core of many of these types of investor requests that we get, and it is a good framework for discussing with investors. Then I think there are also some challenges, of course, that we see, and one is perhaps around how do you disclose and how do you use scenario-based thinking and expectations to integrate that, for example, into financial accounts. I think particularly challenging for us is that climate-related risks are so overlapping with other types of market risks. So how do you sort of isolate climate-related impacts, and how do you also disclose risks that are based on scenarios, which are, after all, not predictions, but sort of backcasting from a certain temperature. So I think there are still some discussions to be had there, but also an area where we see some more standardization.
Thank you. Thank you both for your remarks, and I would now like to invite Martin to join us in the conversation. I think it's a great opportunity to have you both here. Martin, you sort of have two hats on. You have the TCFD hat, but also the PRI hat, so representing the investor perspective. And Hilde, you represent the industry perspective, representing one of the most active players when it comes to ESG disclosure. Investors and companies have been on a long journey, and long in climate finance terms means 4, 5, 6, 7 years, about finding out how reporting is supposed to be designed, what sort of indicators are relevant, and that journey is ongoing. And I think we're seeing more and more details for what reporting is supposed to look like. I want to focus now on where we are now, where we are currently in terms of how these reports are being used. I'm interested in how investors actually, what they do with these reports once they are delivered by companies. How can they be aggregated? How can reports from different companies be compared against one another, and how can they be integrated in allocation decisions? Martin, could you reflect on that a little bit?
Yeah, sure. So I think it's fair to say that the use of these reports have been so far maybe primarily in informing engagement and making sure that you have good engagements. I think that we're not at this stage where you can have the kind of comparability across companies where this is sort of something that you put into a spreadsheet and base sort of tactical asset allocations on, for instance. But I do think that they have been very important in the discussion between investors and corporates. And I think one area where we're seeing, I think, a lot of investor intention is around sort of what is a good dividend policy. And that goes to the heart of this issue of capital allocation. So when a company makes money from its existing business, do you want that money to be reinvested in the existing business model? Or do you want to take that money out and reinvest it in something else? And so that goes really to the heart of this issue of the viability of business models in the face of this climate transition. So I think there's a lot of attention around sort of issues around capital structure, dividend policy. I think we're not at a stage where you can take, reporting from 1,000 different companies and put everything into a spreadsheet and get out some numbers. But that was maybe not ever the intention either. The intention was, I think, more on understanding the capacity of individual organizations to transform themselves and create value for investors. And I see there's a question here I'm just looking at the Q&A in the chat. If I may just answer one of these questions around SMBs, because that's an important question. Because I think we recognize that in many countries, including the Nordics, the vast majority of companies are pretty small and they don't have the resources, abilities, capabilities to do sort of full-fledged exercise. So it's important to think, what is a useful way to approach this? And we have tried, if you look up in the documents that we released a couple of weeks ago from the TCFD and the recommendations on scenarios, we have tried to come up with a little sort of basic cookbook if you're constrained for resources and say, these are the minimum things that you can do. But I think the advice from Hilde is very good, which is just focus on the process. And I think the first thing, if you're an SMB, just make sure that you have an internal discussion at regular intervals around the climate transition. And don't necessarily try to put numbers on everything, but just think conceptually in qualitative terms, how can our company with our business model be affected by the energy transition? And it's not just about downside risks, but also about opportunities. So are there opportunities in the energy transition that we can exploit, and how do we systematically think about those? So I think it's a lot you can do at the conceptual sort of qualitative level that will improve the quality of your strategy process, and focus on that and not about making a fancy glossy report with lots of numbers in it, because that's not really the end objective. It's about improving in a systematic way the quality of your decision-making process.
And that puts a lot of focus on the internal effects of TCFD reporting.
And this is exactly, but so for okay, so you're representing a bank, and I think if you look at the corporate, the structure of in the Nordic countries, banks are usually the most important financial partners for small and medium-sized businesses. So it's not just about the internal process, but I think this is an area where the banking system actually can have a lot of positive effects, because it's also through the discussions that the bank has with its clients that you can bring up these types of issues. And I hope that, high quality banks in the Nordics can play that role of being a creative discussion partner with their clients and add value to their clients, by helping them think in a systematic way around these issues, because these SMBs are typically not listed companies and they don't engage with their shareholders. Many of them are family owned, but they usually engage with banks and finance institutions, and that's where they should be getting that or having that kind of structured discussion around these types of business risks as well.
Duly noted. Since we were talking about the internal perspective and how TCFD reports are not only supposed to be a glossy external product for investors, Hilde, I was wondering if you sort of put those on a scale, the external effects and the internal effects of your TCFD report, which one weighs more?
Well, of course, we need it to be recognized externally because, after all, we get a lot of questions on these topics. So for us, it's been important that we are able to provide information that sort of clarifies some positions and maybe also sometimes explains some misunderstandings around, for example, break even or resilience of the portfolio, etc. So in a way, it's an important channel or way to try to address investor concerns. I would say the external part is important, but maybe equally important internally. And then I think you asked also some questions around, earlier Climate Action 100 and those type of engagement. And I just wanted to add to that, if I could. One thing that we do see, because there is a wish to compare, and it's difficult to compare results and resilience and risks. And maybe at the moment the result is that the comparison focuses on ambitions, and that is interesting in many ways. But I do think maybe that's also an area where, going forward, I would perhaps like to see also more focus on actions and performance, so that we don't turn this into sort of a game around who has the highest ambitions 30 years ahead, but also how do you deliver in the shorter term. I think there's something in the balance there that needs to get right over the next few years. So it's just a thought on the climate action part, but I think we've still it's still not possible to fully compare one company with another based on the climate risk disclosures, but it does provide some insight to whether the topic as such is taken maybe seriously by the management and whether it's a part of strategic discussions. And that, I think, is very important information for investors and financial institutions.
Yes, I think that is very much one of the key points of the governance part of the four pillars of the TCFD, and it's interesting to hear your reflections on this. TCFD, however, is only one of many climate-related and sustainability-related frameworks out there that companies are asked to report to. When we look at CDP, when we look at different other, like the Greenhouse Gas Protocol, when we look at now coming up from the European Union, the NFRD, there is an increasing number of sustainability reporting frameworks. And I personally have a bit of a concern that sustainability can at some point become a reporting burden and a reporting fatigue as a result. This is a question to both of you, how do you two think can we align all of the different sustainability frameworks there are? So if we start with the TCFD, how can this be integrated with others, or has it already been integrated with other frameworks?
Yeah, maybe I can start. This is a huge question, and I see there's also in the chat a question along the same lines. So the PRI has announced a few weeks ago that we'll go into a partnership with the World Business Council on Sustainable Development on these issues, bringing investors and corporates together on these issues, because this is not something that can be left to standard setters alone. And we want to put pressure on that community to to have more convergence of standards. So a couple of notable things here. One is, I think it's important to understand that in this whole family of different frameworks, I think it's useful maybe to distinguish between those who are primarily focused on impact. So they're primarily about how corporates affect their external environment. So these are things like GRI, like CDP on climate. Then you have a family of reporting standards that are primarily around financial materiality, so primarily around how the external environment can affect the companies. And TCFD is primarily in that sort of family, along with the IRC, SASB, etc. So I think the first step is probably to make sure that we have a good set some good principles for what do we mean by good impact reporting and what do we mean by good risk reporting. And then the second step is trying to make sure that these reports build on the unified data set so that we can actually extract the same data for using in both reports. If you look at the climate issue, obviously how companies affect the climate and how climate change, climate policy affect the companies are different issues, but they're very related. And it's reasonable to think that a company with a large negative impact on climate also faces a larger transition risk. So these are related concepts, and that's where we need to bring together more convergence and standardization, in the sense that if you look at today's standards, for instance, they have different sector definitions, different materiality thresholds, etc. So that's one aspect. It's more the analytical part of this. And then there's more the institutional part of this, where I think a very important development has been the IFRS Foundation now going out and seeking views on their role going forward. They said that they would start with climate, which is a good start. My view is that it should be more ambitious than that, because I think the IFRS is really, if you're looking ahead, the long-term maybe home of more standardized reporting. And I think that can also contribute to erasing to what's to me a completely artificial distinction between financial and non-financial reporting. Having IFRS standards for everything across the board, where you fully integrate today's financial and non-financial in one standardized framework, I think would be sort of a long-term solution. But that's, of course, very far down the road, and lots has to happen. I think also a very positive step was the recent announcement from IRC and SASB, where they would merge, and they belong to this family of risk reporting based on financial materiality. So I think that's a very also useful first step. But you can be sure that the PRI will continue on behalf of the US community to really push for progress on these issues.
Thank you. And you mentioned one very important thing, and that is the access to a common data, a pool of data that can inform all of these different reportings, which again would require that the indicators that these reports and reporting standards ask for are harmonized along with other harmonizations. Hilde, over to you. I was wondering, how did you, or how does Equinor experience the landscape of sustainability reporting in terms of impact, in terms of risk exposure, and are there any synergy effects that you can identify that if you do one, you've sort of done half of the other as well?
Yeah, it's a big question. I think we struggle, as all other companies, with the sort of amount of different standards and ratings, and in particular, one of the challenges companies face is that you can, with the same data set, be evaluated very differently in different ESG ratings. So it's difficult to understand sort of the logic, and it's not always very transparent either how you as a company are evaluated. So of course, we very much encourage standardization. We want to be open, but the more standardization and the more common framework you could get, the better from a company perspective. However, I do think there are some issues around materiality and relevance for specific industries, maybe even geographical settings, etc. That needs to be considered along the way. So we have been in dialogue, for example, with the World Economic Forum initiative on common ESG metrics. We're also collaborating with peers on trying to standardize more around these transition metrics for the oil and gas industry, just to try to make our disclosures comparable. So something we definitely look forward to. I just wanted to say that I think it's a key point, this difference between some frameworks look at risk to the business and other look at sustainability impact. And that's a key difference. I do think over time, though, that maybe more of the sustainability impact will also become financially relevant risk to the business. But at the moment, we're maybe not able to measure whether it's biodiversity risks or the externalities are not sufficiently penalized in a way to constitute a risk. But I do think over time, maybe we will see that more of those are also financial risks. But I think we need standardization, and with that, I think we need some simplification also. So some might have to give a little and be pragmatic so that we have a simpler and more common standard going forward.
Thank you. We're approaching the end of the hour, but I wanted to use the last 1 or 2 minutes for a very quick question that has been on my mind. The Sustainable Finance Action Plan by the European Commission is going ahead with remarkable speed, and we're seeing maybe the 2 major pieces, the taxonomy and the Non-Financial Reporting Directive, most likely being finalized next year. Very quick reactions from both of you. Do you think this will make sustainability reporting easier? Will this be a force for harmonization, or will this be yet another thing that you need to report on?
Good question. I think in the short term, probably just another thing to report on, because it's not really aligned. The other frameworks are more at the corporate level. The taxonomy is at the activity level. So it tries to measure something different. The TCFD is about the organization strategy. It's not about the measuring individual activities. So particularly, I think for the corporate sector, the requirements to disclose around sort of details at the activity level is something conceptually very different from the existing reporting, a lot of the existing reporting obligations that are there. But it will, of course, increase the amount of information available to markets and over time promote, better reporting. So I think maybe it's a difference between the long-term and the short-term effect. But in the short term, this is another set of reporting obligations that are not really coordinated with the existing frameworks to a significant degree. So this will be challenging.
Hilde, your reflections?
Yeah, I have to ditto Matthew's perspective there. I think, in the first instance, it will be yet another reporting framework. So, and also a bit more sort of binary than the other frameworks. So, however, I think there might be opportunities sort of with the themes selected for the taxonomy to sort of build on those or find ways to connect that to the larger ecosystem of standards and reporting frameworks.
Good. So there's hope. Good. Thank you both very much. Thank you, Martin. Thank you, Hilde. I think this was both interesting and gave me a lot of ideas, and I hope our viewers and listeners as well. And maybe also more questions. Sometimes you end up being confused on a higher level, but then we're able to ask more questions. So this has been a lot of fun and very interesting. Thank you both very much. And I will now give the word to Nonto, I believe, who's ready for the next section in the program.
I'm just going to introduce the Climate Disclosure Standards Board. While the slides are busy loading, I think it's good to just touch on what we've been doing and sort of provide that background before I talk about what we're seeing in the market with regards to the reviews that we conducted looking at climate and environmental disclosure. So we are a consortium of 9 environmental and business NGOs. We were founded at the World Economic Forum in Davos in 2007. Our mission is to create enabling conditions for the integration of decision-useful climate and environmental information into mainstream reporting. So how we achieve our mission is really by providing the CDSB framework, which helps companies to actually take this information and sort of place it alongside financial information within mainstream reporting. And as I'm just waiting for the slides to sort of load, one other point that I'd like to make is that we have been actually conducting a 4-year project, which is funded by the EU LIFE program. So what I'll be sharing today is really the insights from the work that we've been conducting under that particular project. And just as I just wait to see that everything is in order, and the slides. So just whilst I'm still awaiting the slides to go on, another point to mention is that we actually released the second of the reviews that we conducted, looking at climate and environmental disclosure under the Directive Symptoms Implementation in 2017. And then the third of these reviews will actually be published in December, on the 7th of December this year. So we're looking forward to sharing the full insights of that report with you. Okay. So we conducted a review looking at 50 companies with regards to their disclosures under the directive, and looking at 10 jurisdictions. And then just to mention that these were actually some of Europe's largest companies, and they actually make up a market cap of 3.5 trillion in terms of market capitalization. And one thing that to note is that we were looking primarily at mainstream reporting, so how these companies are disclosing in the mainstream report, and if the primary sort of point of disclosure was outside of that report, then we would be looking at that as well. And also where there was referencing within the mainstream report, we looked at that particular aspect. And then just a reminder that we're looking at the content categories of the directive and TCFD elements on how the companies in the EU are disclosing this. And our review consisted of a qualitative and a quantitative question set. Slide, please. So in terms of the state of disclosure in 2020, so the review that will be published in December this year, we actually are finding that TCFD adoption is not really where it should be. I think some of the points have been highlighted earlier as well, in terms of that, even though we did find in our review that 68% of the companies are referencing TCFD, we found that only 16%, so a very low number actually, are demonstrating some reasonable alignment with the recommendation. Next slide, please. And then in terms of the first element that we're considering as well is governance. So we looked at whether board and management level responsibilities are being disclosed across the board by the companies, by that we mean combined, so not just one aspect. We found that most companies are disclosing, and this has actually improved even from the last year. We do find, however, that there are some inconsistencies with some companies only, for example, just focusing on board level responsibilities, and sometimes climate-related accountabilities are implied within the descriptions around governance of climate-related issues. And since we also looked at environmental issues as part of the review, those aspects as well. And then a key thing to note is that sometimes companies that were disclosing were actually not linking those disclosures around governance to overall risk management processes. So we encourage companies to always kind of show the linkage between all these elements as they're meant to be considered together, so the risk management descriptions as well as governance aspects. Next slide, please. And then when we look at the Nordics, we found that there was a bit of I would say, companies in the Nordics not really doing as well as the EU average with regards to the combined disclosure of climate issues around and how board and management sort of responsibilities around that are being conducted in the organization. And then where companies were disclosing on this aspect, we found that Nordic companies actually would focus then mostly on board level responsibility. Next slide, please. And then in terms of strategy, so one thing to note is that we did see that most companies are disclosing on climate and environmental risk, and also we saw some improvement regarding transition risk and physical risk, which are, as you know, an aspect that is mentioned within the TCFD recommendations. So more companies are actually starting to be kind of explicit in defining those different risk types. And one thing, though, where we're finding companies still finding challenges in doing is talking about the impact on the business model, so the impact of those risks and sort of how TCFD kind of defines the impact on strategy, and also defining time horizons, another aspect that is raised under TCFD recommendations. And then with in terms of Nordic companies, we were finding that only 57%, not really shown here on the slide, actually were disclosing on climate or environmental risk. So I mentioned environmental risk because also we did consider that, and there are some linkages, as you know, between that the two sort of risks, the broader environmental risk and climate risk. Next slide, please. And then moving on to a part which is linked to strategy, which is scenario analysis. So with Nordic companies, we found that in line with what we saw in the EU as an average as a whole, companies are actually not disclosing on resilience with regards to climate scenarios. And with Nordic companies, we're finding that, again, less companies actually were reaching a conclusion on resilience, so 14% versus 18%, and Nordic companies more likely to reference the scenarios, but not really go into sufficient detail on progress. Next slide, please. And then moving on to risk management, so the management actions regarding risk. So we found that most companies are disclosing, although perhaps due to a slight change in the sample size, we find that number sort of going down overall. But management actions for risk are not being disclosed by more than a third of the companies, so still some development sort of required in this area. And another aspect is also climate risk integration into wider risk management. So that's something that we know is mentioned in TCFD was one of the elements. And we found that it was a good thing that most companies were actually doing that. But one thing to note is that when we were analyzing the report, a lot of it had to be implied, kind of like assumed to be implied in the reporting. So a company maybe mentioned sort of climate risk issues elsewhere, and then when they're describing that sustainability is included in the overall process, and the assumption is made that included, but no explicit mention of climate issues in the risk management process and the overall sort of how it links to overall company-wide risk management process. Next slide, please. And then just a mention again to highlight that Nordic companies, actually their disclosure again is, as I highlighted earlier, is lower on terms of climate or environmental risk, and as well as when it comes to management action for climate and environmental risk. So there is quite a big difference there with the companies that were in our sample. So still some way to go in that. Next slide, please. And then moving on to metrics and targets. So this is quite an interesting area in that we did see a great deal of improvement over time with the different sort of parts relating to these climate environmental aspects and metrics and targets. For example, GHG emissions, which is, as you know, is a really developed area of disclosure. Most companies disclosing on that, as well as energy and water. However, we do know that there are some new aspects where companies are really sort of not reflecting this information in their reporting. They're starting to, so biodiversity and deforestation aspects and forest degradation aspects were actually quite low. As you can see, 10% and 4%. So companies are only just sort of coming to terms with how to actually place this information with limited information on issues around targets for these aspects. And then the thing I would like to highlight in terms of TCFD is really the issue of climate-related financial metrics. So we are finding that very few companies are doing that, and we are encouraging companies to sort of consider those types of metrics as well. I think, as Michael mentioned, sort of the F part, so the financial part, is sometimes missing with regards to disclosure on these aspects. And with Nordic companies, just to highlight that we didn't really find that companies disclosing on these climate-related financial metrics in the sample that we were looking at. Next slide, please. And then just a reminder that the full sort of findings will be provided in the report that will be launched again, as I mentioned, on the 7th of December. So not just TCFD, but overall the EU Non-Financial Reporting Directive and how companies are disclosing in terms of progress. Next slide, please. And then just as a final point to mention that there is quite a bit of work that CDSB is doing in order to support companies under the EU Live program funding, which I mentioned earlier. So one key thing is disclosure feedback, discussing where companies want to go and supporting companies with regards to that, these aspects of TCFD particularly, and then also our strong policy team as well, who can also support in discussions and work access to workshops, resources, and also some conversations with finance teams or sustainability teams around this topic. So that brings me to, I think it's the resources slide. Next slide. Just a reminder that we do have several resources that are available. Some of them is focusing on TCFD that you see here. I encourage you all to kind of visit the Knowledge Hub as well for the free e-learning courses that are really great, that have really supported companies also in their journey towards TCFD alignment. Thank you. I will now hand over to Luke Blauer, who will actually be really moderating a really great segment. So, which has obviously the three sort of case studies that we will be, so Luke will be moderating for Stora Enso, as well as Skanska, and we also have Orsted joining. So, Luke from the World Business Council for Sustainable Development. Oh, thank you.
Thanks so much, Nonto. Thank you, CDSB, Nordea, for the invitation, and very glad to collaborate with you on this. And thank you, Hilda and Martin, for mentoring our work with PRI and our work on the TCFD Preparer Forums. As Nonto just shared, the intention of this section here is to dig a little deeper into the experience of leading companies in terms of TCFD progress and learnings and response. And we will shortly hear from a couple of leading Nordic companies. I just wanted to start off by sharing some reflections on our work, convening leading companies and leading our discussions with our members on TCFD implementation. So we do that through what we call TCFD Prepare Forums. So a little while ago, around the launch of the recommendations, the TCFD itself asked WBCSD to coordinate and convene Prepare Forums for leading non-financial companies, leading participants in the real economy from the priority sectors that the TCFD set out. You can see those on screen here. The intention for these groups is to think about the current state of practice, common challenges, how can we overcome those challenges, and how can we set out some suggestions on a path ahead and the disclosure developments over time. So you'll see on the next slide some of the companies who participated in those groups, and of course we were delighted to have Hilda and colleagues from Equinor within the first initiative looking at oil and gas. We then went into a deep dive on electric utilities, then chemicals. On the next slide you'll see we went into food, agriculture, forest products, construction and building materials, and autos. And delighted again that we have Roy from Stora Enso, who participated in one of these groups, and Amelia from Skanska, who participated in another. So on the next slide, you'll see just some headlines in terms of the outputs and the focus, I guess, some of the discussions of these groups. There's a number of resources and reports you can find on the WBCSD website, and a lot of kind of rich content in terms of examples and suggestions and top tips. But to pick out a couple of highlights, we, in particular in the food, agriculture, forest products Prepare Forum, looked specifically at this question of how do you respond to the characteristics of climate-related risk within your enterprise risk management process. And we looked actually at, well, how do you begin to understand the impacts and effects of extreme weather, and how could your risk management process include that consideration. In other groups, in particular oil and gas and electric utilities, we looked at the strategic response to the low carbon transition in terms of portfolio development, optimization, and the investment, of course, within generation and non-generation activities in electric utilities case. In others, we looked in particular at resilience and thinking about, okay, what are the characteristics and criteria that can help that understanding of resilience and responding to that challenging part of the TCFD recommendations. Within the chemicals group, we looked specifically at what are the key parameters and considerations associated with constructing scenario analysis as we think about that kind of downscaling that occurs when you take the reference scenarios and key materials from IEA, IPCC, IRENA, and then apply them to your business context. Within the construction and building materials, we look specifically at the value chain dynamics and what's the distribution of risk and what's the collective approach to the response to the risk and opportunity associated with climate issues. And throughout, we had this suggestions on climate metrics, building on the illustrative metrics from TCFD, and we had insights from the users, the investors who are responding to these disclosures. So do take a look at those insights, and without further ado, let's get into some of these learnings from key sectors. It's great to have perspective here from energy, from built environment, from Skanska, and on materials from Stora Enso. So I'll first hand over to Christine Sadisky, who's head of ESG engagement, global sustainability group stakeholder relations at Ørsted, and we look forward to hearing your insights, Christine.
Okay, thank you so much. Happy to be here. I'm going to talk about, as briefly as possible, our TCFD implementation journey in Ørsted so far. So just quickly, most people know us still for our offshore wind business. So we're the global leader in offshore wind. We have offshore wind farms across the world or in many places at this point. Most recently expanded to the US and Taiwan. Traditionally, we were positioned in Northwestern Europe. A new business that is also growing at the moment is our onshore business, so the US onshore wind portfolio as well as storage and solar. And then we have our heritage business with the power stations in Denmark that we have converted from coal and gas to sustainable biomass over the past few years. So that's been part of the transformation we've been through as a company, where we've gone from basically being one of the most fossil fuel intensive utilities in Europe to being a global leader in renewable energy over the past decade. So the next slide here really shows how that transformation has expressed itself in the numbers, in the financial numbers and our business as such. So we've reduced CO2 emissions by 85% since 2007. We have our share of renewables has increased from 7% of our EBITDA in 2007 to 98% of our earnings in 2020. And then also, while that has happened, as I also touched upon on the previous slide, was that we've become a much more international company. We're headquartered in Denmark, but today 91% of our earnings are actually outside of Denmark. And our return on capital employed has also increased significantly over the past decade or so. So this has been quite a journey for us, and it's also one of the reasons that we thought TCFD was, of course, very relevant to us. We see ourselves today as a climate action leader. That's what we want to be. So for us, it was natural to be one of the first companies who looked into the TCFD recommendations as they emerged back in 2017, and then started to work with that. Our vision is a world that runs entirely on green energy. So it's a bit different from a lot of other companies' visions, perhaps, where they have a vision for their own company. We actually have a vision for the world as well. And then our mission is to contribute to that, of course, with the technologies that we deploy. So what we've done with the TCFD is to assess the impact that climate change can have on the resilience of our business by implementing the recommendations. And we've done that throughout the past few years. We were included as a case example in the TCFD status report from June in 2019. And we're also on the TCFD Knowledge Hub with a case. If anyone is more interested in our work, they can go and look at that. So this is, I know it's quite a busy slide, but if we just, this is to show our journey that we've gone through in our company with TCFD and kind of highlight points. So if we just start from the beginning, in 2018, we decided that the first step we wanted to do was to find out how aligned we already were with the TCFD recommendations, because the TCFD recommendations were new, but we had already been through quite the journey at that point towards a renewable energy company. So we had an idea that we were probably going to be somewhat aligned with them already, and then trying to figure out what are the gaps that we then need to look at. So we did a gap analysis as the first step. And we found out that, as expected, since our business model is centered around climate change, climate action, we were already aligned. But we'd also had some very important gaps that we wanted to close, amongst others, on the scenario analysis, and a few other things that are in the next boxes here. So we had a science-based greenhouse gas reduction target as well. So that is also a way to look at scenarios on the strategy side. We then decided to officially endorse the TCFD recommendations. The first low-hanging fruits we then wanted to implement from the gap analysis was things we're already doing to an extent, but didn't tell about in our annual reporting. So we wanted to make sure that that was more clear, the way that climate change was integrated into a risk process, for example. So we made sure that this was more clear from the annual report and in our strategy process, not least, how our investments, allocation of capital were really towards climate action. So we also then, which was not necessarily low-hanging fruit, but it was actually surprisingly, I wouldn't say easy, but it was surprisingly it was really part of the culture in the company already that climate change was so high on the agenda. So getting it established into the CEO and CFO incentive schemes there was not a lot of resistance towards that. So that was really positive. So that's also one of the things we had done in 2018 and reported on from 2019. We then turned our focus towards the scenario analysis. We decided to focus here on our offshore business, since that at that time accounted for 87% of our earnings. So to start somewhere and not try to really do everything at once, because we have quite a diversified business, and it would be a very big task to do a thorough climate scenario analysis on all of it and all the supply chains and so on. So we started here to look at the physical climate change risks for our offshore assets, basically, because you could say that the strategy is already aligned with these lower degree scenarios, but we wanted to find out at a corporate level how those physical climate change risks could manifest and whether that would be a risk to our offshore business. We then concluded that it was well positioned to manage those physical climate change risks, and that we also reported on that in our annual report. And that was regardless of the scenario, because you have something called engineering safety factors that really account for a lot of variety here on weather patterns. One thing we couldn't conclude on was wind patterns, because there were basically no models to predict that with the precision that we needed in terms of trying to then predict what that would do to earnings. So that part was inconclusive in terms of the scenarios. We did that through interviews, workshop. We had some external consultants come in and help us with that as well. Later in 19 and the beginning of 2020, we also set some new and even more ambitious carbon targets. So we decided to become carbon neutral by 2025 in our own operations, so scope 1 and 2 emissions, and then in our entire carbon footprint by 2040. So scope 1, 2, and 3 emissions to become carbon neutral 10 years before it's actually required by science, you could say, in terms of the 1.5 degree threshold temperature rise. And we then also, in order to try and reach that target, we launched a supply chain decarbonization program, which we've also been then working further on this year. And we're going to report more on in the upcoming annual report. So what has all of this done? We also, as you can see on this slide, and I'm not going to go through it, but we had a lot of internal stakeholders involved. So it's not just us. I'm sort of in the sustainability department, but work very closely together with lots of other departments, as you can see here in the blueprint under the boxes. So I had the project management responsibility for this, but it was really anchored in the finance organization. I think that's also important to say, that it is important that the TCFD recommendations and their implementation are to be seen as a financial task, but in a close collaboration across the departments. So that was also really useful that we got that collaboration established in a way that it hadn't been before. So it improved our internal understanding of climate-related risks and opportunities by also starting to work more closely together. And we also managed to get some more, hopefully, decision-useful climate-related information provided to our investors, and also in our CDP response, which then also, amongst other things, has put us on the A list in the CDP reporting landscape. So finishing off with the 5 key things we then learned from this TCFD implementation journey that we've had, and especially the scenario analysis. We've used it to provoke internal thinking and improve our external reporting. So that was really what the last slide also said, that you have this kind of dual benefit. Secondly, realistic scoping is key. I mentioned that we decided to focus on physical climate change risks for offshore business in our scenario analysis, and that was because we needed to be realistic about where do we start, and then you can always build on from there. And I think that's an important message to send as well, that you don't have to do everything at once, but really start taking some steps. Thirdly, bring the experts together from across your business. So that was all the different departments. Get them together, start talking, including the sort of engineers out in the real world that you maybe don't normally talk to at the corporate level. So that is something that is really useful to get that knowledge centered and being able to report on it ultimately. And then work constructively with the best available science. This was one of the challenges we had, being a company that has a lot of engineers, as mentioned, and they like precision. So there is a challenge here that the scenarios that exist around climate change and the different temperature rises, they are not necessarily as precise, because it's basically impossible to do that, because it is predictions, it's looking into the crystal ball. So it's by nature, it's not really something that's extremely precise, but try and work with it, see what you can do, and go from there. And then don't wait for perfection. Get started. We need more companies who we need a bigger sort of array of examples. Then it'll become easier for everyone as well to get going if they have some examples that they can draw on.
Thanks so much, Christine. A really fascinating insight, and in particular, kind of the learnings on the physical scenario work. I'm a little conscious of time, so we might actually move straight on to Roy, if that's okay. Conscious that Roy needs to another appointment. So yes, introducing Roy Antic, SVP International Policy Coordination at Stora Enso, part of the sustainability team. And yeah, over to you, Roy. Great to hear your insights.
Thanks, Luke. I hope you can hear me. Yeah, so Stora Enso is a company that is producing renewable materials in what we say is circular bioeconomy. And so in all of this, it's for us, it's very important to sort of look at the opportunity in transition. We're obviously trying to look for solutions that can play a significant role in the transition to a low carbon and circular economy. Next slide, please. Thank you. So global warming and sort of combat the global warming is an extremely important aspect of our sort of corporate strategy. We own forests. We have access to residues that form biomass in our energy production in our production assets, and as just said, we produce products that we hope can play a significant role in this transition, and obviously also in the low carbon circular economy. So we've been working on this particular topic since 2008 and perhaps even earlier. And so we were significantly reducing scope 1 and 2 emissions, and we've achieved reasonable assurance on our scope 1 and 2 emissions for a couple of years in a row. And we have been the first in the industry to get out with a science-based target. In terms of the TCFD, I'd say we were very happy to work closely with the World Business Council. Luke's colleagues early on have helped us create internal awareness. One of Luke's colleagues was even attending one of our big sort of cross-functional meetings internally to help us understand the implications of the recommendations. So our initial response was that we do a lot. We have a lot. We have climate change properly well integrated into our ERM system. Though we should say that the different time horizons of the traditional ERM and climate change do cause its challenges. But we have a lot of things in place, including the use of sensitivity analysis and stress tests on certain aspects of our ERM. So the first thing we thought we'll do is to provide for a separate sort of online summary of how our current efforts respond to the recommendations. We did so for our 2018-2019 results. It can be found online. And it is a summary of governance, strategy, risk and opportunity management, but also metrics, targets, and some specific highlights as to what has been achieved during the year with some external recognitions. And I'd like to highlight that this was a first response. I mean, it was earlier said that the TCFD is not after separate reporting. In fact, the objective is to create or address all this in the existing financial reporting. But regardless, this is something that we felt was useful in helping create further awareness. And it's also sort of probably good to say that, and it's been said before, that in all this is extremely important to get senior management on board, which in this early stages sort of really worked well, in part due to the efforts of the WBCSD to help us sort of create this awareness, but also because of our executives seeing that this is something that's really necessary and will really and truly help the communication of efforts and hopefully also the sort of competitive position going forward. So we have both our CFO being part of a significant effort with the A4S, Accounting for Sustainability, and our Executive Vice President for Sustainability part of the efforts within the WBCSD. Luke, perhaps next slide. And as just also mentioned by Christine, our starting position was also so that, we have a lot in place. So why not first look at what we have in place to identify perhaps gaps? And this was actually a very nice sort of overlap with the Preparer Forum project of the WBCSD. And the Preparer Forum work allowed us to do, with the help of the WBCSD and their consultants, to do a gap analysis. And with that, we sort of provided a lens on the aspects that we need to address going forward, and also the things that we can confidently already sort of highlight as aspects that address or respond to the TCFD recommendations. To sort of start following up on this gap analysis, we also, as Christine earlier said, established cross-functional group because it's extremely important that this is being addressed across functions, and that particularly the input from investor relations, but also from finance and other aspects, sustainability, will be considered in all this. So following through on this gap analysis, we then first decided with this group that perhaps we can sort of show and guide our audiences for the annual report as to where they can find the specifics of the TCFD responses. Now, Luc, please, yes, next slide. So that was really important. One thing sort of in the work with the Preparer Forum that came up is that as part of sort of proving strategic resilience, and as you can no doubt understand, importance for a company like ourselves trying to benefit or monetize this sort of transition period to position low carbon circular economy products, is to sort of phrase and articulate the opportunity. And it's one thing to do that with market forecasts, but I think before doing a certain market forecast, it needs to be complemented with sort of a science-based approach to sort of articulating the size of this opportunity. And one thing we've done is to work closely with parties, academia, is to find a way to, at portfolio level, estimate the substitution potential of our products, and sort of include that in our disclosure, and also to include that in a way that it's part of our net climate impact. And I think this is extremely important. This is important for us. And, you know, based on the fact that you then have an articulation of the climate benefits of products, you can then start to bring in, perhaps next slide, look, some other sort of product-related forecasts as they associate with the substitution opportunity in your reporting. So, and this was and is a very important aspect for us. We're continuing this work on this sort of science-based narrative for our products. Perhaps a remark to be made here is that whilst we're doing this, to really sort of move this forward as part of opportunity assessment in disclosures, it will benefit sort of a much wider and standardized approach to the opportunity assessment. And this is something that we always state and we're very keen on. And in fact, we're through the WCSD in collaboration with WRI are sort of involved in trying to establish this framework for sort of a standard to consistently report on carbon storage and substitution benefits. So this was an important aspect for us. In terms of gaps, scenarios are a gap. Perhaps I won't dwell in too much detail, but the challenge there is that we have so many different assets, from plantations in Latin America and China to forest assets in Europe and manufacturing assets all around the world. So it's addressing this and finding this balance between pragmatic and yet science-based scenario approach is one thing that is at the moment keeping us busy. Luc, I'll leave it there.
Thanks so much, Roy, and yeah, really helpful to hear those insights on the importance of describing the opportunity and building the knowledge and understanding on the size of the opportunity and the transitions that are needed for us to realize the objectives and ambitions of Paris. Again, conscious of time, I think we'll move on to hear from Amelia, and yeah, great to complement the perspective of an energy company and a materials company with that of player very active in the built environment, the complex value chain, of course, but lots of leadership being shown by Skanska. So over to you, Emily.
Thank you so much, and thank you for inviting me, and I'll hope you are energized for about 10 more minutes. So my name is Emilia Hagberg. I'm Senior Sustainability Manager, and I'm heading up our sustainability reporting, but I'm also working a lot with our strategy work. Firstly, just present you to Skanska exactly. Skanska is a construction and development corporate, and we are based in Stockholm, Sweden. That is where we have our headquarters, but we have operations in the Nordics, in Central Europe, UK, and also in US, where we have about 40% of the business. So it's kind of a complex and business with very local projects. You can move to the next one. So the construction sector stands for about 40% of the energy-related carbon emissions globally, and the good news about that is everything that we do in the sector, it has a lot of effect. So for us, we decided to have an ambitious climate target. It was very, very important. It was set by the board. We've been working for a long time with climate issues, but this target has really been an engine to speed up that pace. You can move to the next one. And we are very aware of that our main emissions, they are not in our own operations, but both in the production of the materials, mainly, and also the use of our products. So we need to cooperate throughout the value chain, both when it comes to reducing the emissions, but also to reduce risks and leverage opportunities. You can move on. So since we established our target, there has been improved awareness of the issues on management level, and we have now a follow-up from the board quarterly on our emissions. So and that also increases the focus on risks and opportunities, and also, of course, the governance of this work. There is a high focus now to manage to reach our target. But you can, yeah, okay, let's stay there. The risks for Skanska, of course, I mean, we are working in projects. They are typically about 5 years. We don't have very much of assets that are kind of long-term. So the risks for us are not adapting to changed regulations and changed market demands fast enough. And so very much for our focus is to meet those demands throughout our value chain, and it needs cooperation. So what you see here is some examples. So we're working with the materials that we use, developing and low carbon and circular concrete is one example. Of course, also the buildings we built. This is an energy positive building in Norway, where you can charge the buses for the surplus energy, and also cutting carbon emissions in our own operations. Here we have cooperation with the provider of the machines for automatization. So this is the way we need to work to adjust to the risks, which is at the same time to leverage our opportunities. So that is our focus. You can take the next one. So when we have been working with implementing the TCFD, we wanted to build on where we stand and to look into the procedures where we are strong. And we have been following up our carbon emissions for more than a decade. We have limited assurance more than 5 years. So we know that we have a strong foundation there. And the improved awareness from the board and follow-up and increased governance perspective has been very, very important, as well as a more comprehensive view on climate action plans. Skanska is very, very decentralized. So all the actions need to be founded in the market where they are, but we can still have an overview, what are the main actions. And to focus on business opportunities, that is for us the way to go. But that also needs close cooperation with our customers. For instance, we have more than half of our business is with public customers. So procurement practices is very important, and how we can support them in this transition. What we now are in the process is to integrate climate risks closer into the enterprise risk management, the regular processes. We have had that before, but it's even more integrated. I would say that the most challenging, or at least what we need to look into, is the time perspective. I heard that was mentioned before. For a company where the time frame is typically about 5 years, the climate perspective is totally different. So we need to work together closely about that. But what is most challenging for us is and I guess that is for other companies as well, it is this integration of climate follow-up and performance measuring with financial reporting. My view is that the reason for that is the different cultures and backgrounds. Financial reporting has centuries of history to build on, and sustainability reporting is much less mature, and the people working with sustainability come from a more passionate background, and now we need to have the same language and the same culture. We are working very hard on this. And we are also working on having more economic incentives. There it is incentivized in the bonus agreement for our CEO, and we're also looking into how we can use an internal carbon pricing system within our operation. I hand over to you, Luke. Thank you.
Thanks so much, Amelia. Yeah, really interesting to hear, of course, the connections and relationships are so important in your value chain, and the engagement you have with customers and suppliers to ensure we have that pursuit of net zero. I'm going to actually hand back to Nordea colleagues. I'm very conscious of time now, but thank you all so much, Amelia, Christine, and Roy, for your contributions. Great to hear those insights from in the sectors. Thank you.
Thank you so much, Luke. We have about a minute or two to go. Before I sort of formally conclude the day, Luke, is perhaps on your side anything you just want to conclude with, any overall reflecting remarks on what we've heard?
Sure. Yeah. Thanks. So, well, I think from our side, WBCFD, and having worked with a number of companies, clearly there's a lot of challenges that remain on financial disclosure, on the use of reference scenarios, development of reference scenarios, this integration into risk management, among many other themes. But I think the key thing that we're also sort of pivoting to is, we started with this sort of risk and risk exposure conversation in TCFD, but increasingly we're talking about transition planning. We're talking about the pursuit of opportunities and ensuring that there's that dialogue and that understanding in the market of what those opportunities look like and how we can realize their potential. So I think, overall reflection, let's consider that balance of risk and opportunity, and let's think about how we accelerate that transition planning.
Thank you so much for that, Luke. I think that was a good balanced way of rounding off, and I think we've obviously covered a lot of ground in the last 2 hours. Clear there's a need to further engage on this, and I think really the engagement in the market between companies and investors is really one of the keys for us to continue to working with this as a market and move forward. I think it's fair to say that this is something that still is separate to perhaps mainstream discussions, but that we are clearly seeing, as many different people have highlighted today, that this is something that we are expecting to go more and more into mainstream, and indeed maybe one day become part of the mainstream without us giving any further considerations to it. I would personally love to see that. I think it's still a bit early to sort of guess when that would be, but there's some interesting developments happening just over the last couple of weeks and months. So with that being said, it's 12 o'clock CET. Thank you everyone who's taken the time to listen to this first Nordic TCFD reporting summit. I hope you enjoyed it. Please feel free to send through any feedback, reflections, questions that you may have. We're happy to pick it up again next year if we believe we can find an appropriate platform and an audience for that. I think today has demonstrated that with more than 130 people listening in for most of the event. So a great event. And again, I'd like to take the opportunity to thank as well Michael and Nonto from the CDSB in helping to run this, and obviously to all the speakers that have shared their time and their views with us today. So thank you all. And thank you all for listening in, and I wish you a wonderful day, and Merry Christmas.